Hello again and welcome back to another session of Commerce class with me, Suman Rathore. Students, commercial banks play an important role in providing short-term and medium-term finance to business organizations for various purposes. Now, these loans can be secured loans or unsecured loans and can be repaid in lump sum or in installments over a period of time. Now, banks prefer to provide such financial assistance as they get good return or interest in return. And also, their money is not blocked for a long period of time. But they have to work in accordance with the instructions provided by RBI as to the extent of loan, kind of securities, etc. Now, loans from commercial banks include term loans, cash credit, discounting of bills of exchange, and overdraft. Now, let's understand these one by one. So, first is term loans. Banks now offer loans to business firms for medium term and short term period. These loans can be secured and unsecured. However, a secured loan usually have a low interest rate than unsecured one, and loans are generally secured by assets or guarantee. The borrower may be asked to repay in lump sum or in installments as per his convenience. Next is cash credit. Now, cash credit is a formal and revolving credit agreement, and revolving in the sense that the borrower is allowed to borrow money repeatedly up to the specified limit. The amount may be withdrawn in installments and interest is charged on the amount actually withdrawn by the borrower. The borrower is required to offer security in the form of tangible assets or guarantees. Next is discounting of bills of exchange. Commercial banks provide short-term finance to business concerns by discounting their bills of exchange, promissory notes, and hundies. Banks charge some commission for this service by paying a price lower than the face value of the credit instrument. The holder of the instrument remains liable to the bank if the instrument is dishonored on maturity. Next is overdraft. An overdraft is a kind of temporary financial accommodation extended by banks to its regular customers. Under this, a customer can withdraw funds greater than what are available in their current account, and business enterprises enter into such agreements to take care of their temporary shortage of working capital. Interest is charged on the amount actually withdrawn by the customer, and it is considered as a source of short-term funding which can be covered with the next deposit. Now, raising finance through commercial banks have various benefits. Like first is timely financial assistance. Now, finance is provided as and when needed by the business firm, and timely availability of funds helps in smooth running of the business. Second is secrecy of business. Now, banks provide the financial information given by the borrowers confidential. As such, the secrecy of business can be maintained, which is otherwise lacking in other sources of finance. Third is less time consuming. Now, cost of raising finance through commercial bank is very less and it is very less time consuming, as a company doesn't have to incur any expense or time on underwriting or issue of prospectus, etc., which are otherwise involved in raising finance through other sources of finance. Just some paper formalities are needed to be done to get the funds. Next is flexible source of finance. Now, company doesn't have to bear the burden of loans permanently because they are short term, and also company can return the funds in advance if they do not require the funds anymore. As such, loan amount can be increased or repaid as per the requirements of the business. Next is no interference in management. Now, banks fulfill the credit requirements only and doesn't involve itself with the day-to-day working or management of the business. As such, shareholders' interest is not diluted and there is no interference by banks in the management and control of the company. Now, despite all these merits that we have discussed just now, there are certain demerits of raising finance from commercial banks. Like first is short-term financial assistance. Funds from commercial banks are available only for short duration. As such, only the working capital requirement can be fulfilled, and long-term financial requirements are not attended at all. Second is fixed obligation. Now, interest paid on loans is high and it's a kind of fixed obligation, which means that the company has to pay the interest even in case of insufficient profits. And third is personal security. Now, banks may keep stock as security for giving loans. If the businessmen get their raw material or finished goods mortgage, then it is inconvenient to sell those goods. And also, sometimes bank demand personal security from the directors of the company for the payment of the loan. That's all for today. Thanks for staying in tune and don't forget to like and subscribe my channel. Thank you and goodbye for now.